Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today is Jonathan Charlo, also one of our partners and our lead analyst. A copy of today's webinar will be posted to the SilverOak website within the next few days. So if there's anything that you want to go back and listen to, that will be made available here over the next couple of days, as I mentioned. Today's webinar should take approximately 45 to potentially as many as 60 minutes, but I think we're going to probably be on the shorter side of that today, Jonathan. Is that?
I would think so.
Kind of the expectation?
Yes, absolutely.
All right. If you're running other applications on your computer, those may cause interference with the audio. So if you have any audio issues, feel free to close down those other applications, and hopefully that will resolve the issues. We've had that experience by some of the participants in the past. If you have any questions regarding today's materials, like I said, we'll post the webinar to the website, but we also will make ourselves available to answer those questions after today's recording of the webinar. If you're working with your SilverOak advisor, obviously you can reach out to them with your questions, or you can contact me directly at 952-896-5701. And as typical, I want to thank Jonathan and the rest of our team for putting together these materials. It really is every quarter a lot of work to pull this information together in a relatively short time frame, especially as new data is always being released, which just this morning we had the GDP numbers released. And since I'm the compliance officer, I also have to note a couple of compliance items. First of all, during today's webinar, we will not be discussing specific SilverOak portfolio performance, since each of our clients' portfolios are customized. However, obviously by now, all of our clients have received their quarterly performance reports, and many we've probably reached out and talked to, certainly those that may have needed some changes or adjustments, we've reached out or been reaching out and talking to. Nonetheless, if you do have specific questions on your performance report or your portfolio as a whole, again, feel free to reach out to your SilverOak advisor. And lastly, I need to note that in today's webinar, we'll be discussing the overall markets and economy, and in doing so, providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions, and of course, past performance is no guarantee of future success. So with that, I have the agenda pulled up and shown here. We'll spend the first 10 or 15 minutes talking about economic data for the quarter. Then we'll transition into a 10 or 15-minute discussion around the market data and how both the bond market and equity markets performed during this past quarter, and talking a little bit about where we think they're going to be headed, which gets us into the SilverOak outlook, and then into SilverOak updates and some important reminders as we start the second quarter of the year. So with that, let's go to the economy. And Jonathan, you say here, strong growth during the first quarter.
Yeah, absolutely. When we go through it, we've been talking about how data has strengthened over the last year, and it definitely has. But I think we're going to see in some of the data points that maybe we've gotten to a point where they're relatively high and they could be backing down a little bit.
Okay. And with our dashboard, I think we show some of that on the dashboard. This is probably the second or third quarter that we've discussed and shown our market dashboard, which has four major components. At the top, you'll see the economy, and that goes across based on the various quarters, starting with first quarter 2015. running all the way through the first quarter of 2018, where that first red arrow is showing there. And then, of course, we don't have second, third, and fourth quarter 2018 data, so what we're showing here is our projected outlook for these various categories. And in this case, looking at the top row, it's the economy. Okay. The next category is credit markets, then valuations, and of course market sentiment. With at the bottom are composite, and the colors do mean something. So now I'm colorblind, so Jonathan, correct me, but red is bad.
Red is bad.
Red's bad. Grayish is neutral, and green is good.
Correct.
All right.
Correct.
So where are we right now on first quarter, looking down?
So first quarter, again, is unchanged. The composite number is still green. For the last year or so, from a valuation perspective, we've been in red. So valuations are relatively high. Now, as you mentioned, the second, third, and fourth quarter, we're looking at current data, and if that trend continues, what would the data look like at the end of the year? And so that's really what we're looking at. And so what you'll kind of see is if you look at market sentiment, that actually goes to neutral in the third quarter, and then in the fourth quarter, the economy might be more neutral. And so at that point, our composite actually becomes neutral. Now, we don't know for sure whether this will happen because there could be differences in the data that comes out. But again, we're just projecting what we're seeing based on current data if that continues.
Sure. And if we want to see a trend line of this, going to our next chart, we can see here three different lines. One's the S&P 500, excuse me, 500. I'm just getting over a cough, so my apologies. One is the 6-month average of the dashboard composite, and then the third one is the actual dashboard composite. I know it's kind of hard to see, but if you look to the far right, we have a circle showing where we currently are with regards to the dashboard composite. And we even indicate that right now it's at 3.97 or roughly 3.97. That's very positive. Now it's fallen from where it had been, so it's come down a little bit, but it's still what we consider to be positive. If you look at the straight line going across, that's at about 3.25. Can you explain why we have that line there?
So the 3.25, if you kind of look at prior periods, when we see the composite in the 6-month composite go below that level, we've seen either the market, being the S&P 500, has actually gone down, or if you look in the period of 2015, stock and bond returns were actually about the same at that point. And so as we go through the year, we see that composite number actually hit 3.27. That's kind of the estimate, which is right on that line. And again, the last time we saw that was back in 2015, when returns between stock and bonds were relatively the same.
So let's talk big picture on the current economic factors. So we just looked at the dashboard. And of course, a lot of these components go into the dashboard, but big picture, what's still driving the economy from a positive perspective versus maybe being a little bit more neutral or maybe even negative to the economy?
Yeah, so looking here for the quarter, we really had no changes between the different columns. Trends are pretty much in place. So the positives have been really credit, housing, consumer confidence, employment, and corporate sector, which is earnings. There I have a positive arrow. Now, I will fully admit that a good bit of what we're expecting from earnings this year will come from the corporate tax cut, but we do still see growth from an underlying basis of operations. Within the neutral section, though, there are a couple things that are still kind of going on. One thing we'll talk a little bit more today is really what's going on with interest rates. Interest rates have been going up. That's a bit of a negative factor. And when we look at the US dollar, that's been weak. And so that's a bit of a positive factor.
Up until the last 10 days.
Sure.
Just gained back everything it had lost, I think. It's back neutral for the year.
Yeah, again, a lot of the data points, we're starting to see a little bit more volatility. Yep. So things that have been good are a little less good. And that's really going to be something we'll want to watch through the year.
Sure. So if we look at the leading economic indicators, those, though, still tend to be trending higher.
Yeah, now we mentioned a couple quarters ago that a lot of the soft data, so from surveys, have been extremely strong, but that wasn't necessarily followed by hard data being as strong as the soft data. And that really is what we're seeing. So the leading economic indicator index is really a survey. It's somewhat based on forward-looking factors. Those continue to trend higher, and in fact, starting in 17, the slope of this line actually got a bit more steep, and that trend has continued. From a manufacturing standpoint, we're at very, very strong levels. Now, they did back down a little bit in March from the recent high, but when you look at new orders, those are also very strong. When we look at March numbers, 17 of the 18 industries registered growth. So just because the data is coming off a little bit doesn't mean that we think manufacturing activity is going to slow down. Consumer confidence is another one of those where we're at relatively high levels. So if you look really at the far right, you can see on the top little one that we reached a high back in March, and April numbers came down just a little bit. We've seen consumer spending back down a little bit in the first quarter, still at very good levels. So when you look at this level historically, these are numbers that we reached really 10, 15 years ago. So relatively strong, just a little bit off of recent highs.
And of course, this is a big one because consumer spending is 2/3 of the economy. So if people aren't feeling good, they're probably not spending, which means manufacturing is going to slow down and the economy is going to maybe stall.
So yeah, so this is obviously a factor that we're going to want to watch and see if this trend of April coming down further portends to something in the economy in the second half. Now, this is an area that initially for years has been a weak factor, and that's small business confidence. But we did see it really reach historic levels in the last year, and in fact reached levels that we haven't really seen in 20, 30 years. And in fact, based on taxes, we kind of reached new highs recently, and that's come down a little bit. But an interesting factor came up in the surveys in the last couple of months, which is that no longer are taxes the number one problem that small businesses face. The number one problem now is labor quality. Mm-hmm. And so we know that the labor markets are tight, and small businesses kind of have lagged big businesses over the last 5 years in this recovery. So now they're starting to feel better, but now it's hard to actually grow because they're having difficulty finding good people.
Well, and the concern is that's going to spill over to labor costs too. And so even to find good people or keep the people they have, now they got to start raising salaries, and that could spur a little bit more inflation than what might be expected.
And if that occurs, then the Federal Reserve will have to be a little bit more aggressive in raising interest rates.
Yes.
So from a job perspective, so now we're kind of getting into the hard numbers. Job growth recently has been kind of trend line. Now, we did have a very, very large number 2 months ago, and the most recent numbers in March kind of backed down, but they were about 103,000 We saw unemployment unchanged at 4.1%. Now, recently, earlier this week, we saw jobless claims came out, and they fell in April to a level not seen since 1969. So I think what we're really seeing in these numbers is I don't think we should expect to see 200,000 plus consistent job ads per month, just because of where we are in the cycle and how tight the labor market is.
That's a good point. So here's the number that we just got out this morning.
Yeah, it just was announced. So the first estimate for first quarter GDP just came out. It came in at 2.3%. Now that is lower than the fourth quarter, which ultimately came in at 2.9%. So that's a little bit of a slowdown. But when you look at this first quarter number relative to 2017 and 16, which were fairly weak, this is still a good number. But one of the reasons why it did fall from the fourth quarter levels was there was weaker consumer spending in the numbers seen. So we had talked about corporate sector being a strong area in the economy, and that continues. So when we look at the reported earnings fairly recently, you'll see that we're kind of at record levels. Now, the projections going forward are extremely aggressive.
These are really aggressive.
And I think that's somewhat what the markets are trying to really figure out right now is we know that with the corporate tax cut that we're going to see, some say 10, 15, 20% increases in earnings. But one of the things we're going to have to watch is how much of those increases are due to the tax cut and how much is actual underlying strength in businesses. And so I think that's one of the reasons why investors have been watching corporate guidance so carefully in the first quarter earnings.
And of course, probably everybody knows, earlier this week when CAT came out with their earnings, the big issue was is have they hit peak earnings?
Right.
And that caused a lot of volatility earlier in the week because now people are concerned that we're not going to see this trajectory and that maybe where we are now is the peak and they're going to fall off. I think we've always expected that fall off to probably happen next year as we look at year over year, but it sounds like some companies are concerned maybe it's going to happen a little bit sooner.
And it could be that they're trying to lower the bar a little bit at this point.
Could certainly be part of it. So we've talked a lot about the economy, but of course everybody knows that I always make reference to three spheres. We have the economy, we have the markets, and we have politics. And we don't have a section in our webinar about politics, which I'm very happy about. But we do break the webinar into economic discussion versus market discussion because there's not always direct correlation there. So what have we seen with regards to the markets?
So we talked about positive things in the economy. Well, actually, things were weaker in the first quarter. And so what we'll see looking at the market returns is that other than emerging markets, which were positive, really the other major areas of the stock market were actually down a little bit in the first quarter. Now you'll see for the year, still very, very strong, but down a little bit.
And we'll talk in a few minutes about these intra-year declines. And it's not unusual for us to have even greater intra-year declines and yet still finish the year positive. And I think we have a slide that we're going to discuss that. So this is showing all of the equity markets, and as Jonathan mentioned, bifurcation of return. So Q1 not so good, but the year still looking positive. This transitions into the bond markets, and I think you had made reference already that we're going to talk about interest rates because obviously interest rates going up put a little bit of downside pressure on bonds during the first quarter as well, at least more U.S. oriented bonds. You'll see that global bonds were still quite positive. And in most of the portfolios SilverOak manages, we have some allocation to global bonds. So that's really helped with our fixed income performance here so far this year. But of course, as we look even further down, you'll see the one category that's gotten hit pretty significantly is REITs. And as a firm, we really transitioned out of REITs back in, I think it was around October or November of 2017. Not really expecting that the real estate market was going to crash, but we were concerned about the mechanics of the REIT market, specifically real estate investment trust. And in making that call, obviously looking back, it was a smart decision. However, I have to admit, right, Jonathan, when we talked about this, we were thinking of 1 year, 2 year, 3 year kind of transition out, and we weren't doing it because we thought, well, the next 3 months would be a good time to be out. So just keep that in perspective as we're making these kinds of adjustments. We try and make the adjustments over 1, 2, 3 year periods, not from month to month or quarter to quarter. But this one did work to our benefit. Of course, here looking at the equity markets, we've broken it out by market capitalization from small at the bottom to large at the top, and between value and growth. So value to the left of each chart and growth to the right. And of course, it's pretty obvious, growth continuing to drive the markets. And I think you're going to talk a little bit more about that in this next slide or two.
Absolutely. So growth has been strong when you look at it on a quarter basis. So here we're looking at the S&P sectors. And one thing that really jumps out is that in the quarter, and that's in yellow, if you look at the growth sectors at the bottom half of the page, you see that consumer discretionary and technology were positive. Actually, all the other factors were negative during the quarter. And so that then translates to the year where you also see consumer discretionary and technology were the leading sectors. When you look at value, as an example, there really was only one sector that beat the market last year, and that was financials. The second biggest return from value was materials, but that's a really small percentage. And so that really ties into why growth has done better than value. And interestingly, technology makes up about 40% of the growth universe. And so when you factor in that had such a high return and was almost half of that benchmark, it goes to say that growth was so strong. So we have talked a bit about international and how things have been better. So when we look at the first quarter numbers, the thing that really pops out is the left side did better. And that would be the emerging markets, so China, Latin America, the BRIC countries, including Brazil, Russia, India, China. And the right side has been negative, and that would be more of the developed world. So the UK, Germany, and Spain were down. But when you look at it on a one-year basis, still very solid returns, mostly double digit. Obviously, China was extremely strong last year, which also powered the high returns we saw in emerging markets. But when you look on the right side, you'll see, again, very, very solid returns from the developed markets, so especially in Europe.
So we've touched on the equities, and pretty much for the year, looking back 12 months, still strong performance. But obviously we got a little bit of downside for most of the equities on a 3-month, first quarter kind of basis. And we talked earlier that bonds were down a little bit on the 3-month basis as well. And here what we've done is, instead of talking about bonds broadly, we've tried to break it out into the different sectors, with the emerging markets to the far left being maybe the higher risk, and treasuries being the far right being the lower risk.
And so what really pops out for you is that on the far right, Treasury, which has lower risk, actually was down the most. Treasuries are the most sensitive to changes in interest rate because they really don't, by definition, have credit risk. I think the other thing that's interesting that pops out is corporate bonds, which are a little bit more on the left. Obviously they have some credit risk. They also saw a healthy decline during the quarter. And so that really does fall into, I think, the give and take that we've seen between interest rates and where growth is this year. And so to a certain extent, that affected the corporate bonds. When you look at the year, generally speaking, the credit side, so on the left, did a bit better than the right side. Treasuries were actually down for the year. TIPS were actually up a little bit, and that really stems from the fact that inflation expectations are starting to increase. And then I think the other thing that really pops out on the right side is that municipals for the 1 year period had a decent return, and part of that was they made up some losses that they had sustained in the second half of 2016 when there were concerns about whether municipals would remain tax-free.
Sure. So we're going to talk a little bit more about bonds and their kind of the relation that bonds have between interest rates and bond prices. But before we go into those details, let's just touch on SilverOak's overall outlook, both starting with the economy and then transitioning over into the markets.
So looking at the economy, we continue to feel that growth in 2017 will continue into 2018. But again, we're looking at whether or not that growth continues to go at the same pace that we've seen, or whether we're going to see some fallout. When we look at the U.S. side of the economy, we don't really see any indicators, early indicators of a recession. But I think the thing we're really looking at this year and what the markets are focused on is inflation increasing, and if so, what is the Fed's response going to be? And then there would be the worry then that they might be too aggressive and then growth falls.
Sure.
Internationally, we do expect global growth to be relatively strong this year. We did see corporate earnings from international companies were stronger in 2017. We'll likely see that continue this year. And that we also think that, like the U.S., other central banks will start to look to tighten modestly in 2018.
My apologies. I guess I didn't advance the screen fast enough. As far as the equity markets.
Well, obviously one of the biggest changes we saw in the first quarter, and we'll actually address that later in the webinar, is that we did see a pickup in volatility. We think that will likely continue. Valuations for the U.S. market are above average, and that further gains for the market will be somewhat based on meeting relatively high corporate growth expectations. And again, some of that is due to the tax cut, but ultimately it's going to be looking at how growth really shapes up and whether it remains strong as we go through the year. So again, as I mentioned, risks are going to be interest rates and inflation, but we still have other wild card events. There's still North Korea out there. There's still the whole prospect of whether we're going to be in a trade war, or whether we're really just negotiating with a lot of different countries aggressively. So from a positioning standpoint, we would maintain a diversified mix across the equity sectors. One of the things we had mentioned was that growth was so strong relative to value. We don't think that gap that we saw last year will necessarily continue. Now, admittedly, that occurred in the first quarter, but we don't think it will be as wide going forward. International equities still offer compelling valuations. and those fundamentals are still improving. So they're not necessarily dealing with the rate of change issue that we might be seeing in the US. They're probably still remaining strong. And then real assets may offer protection against upside inflation surprises. And so you had mentioned last year in the fourth quarter that we had sold REITs. That was really when we added real assets into our equity allocations.
And just to be clear, we added a diversified real asset. I mean, you could argue that REITs are a real asset, but again, they're packaged in a vehicle, and it was really the vehicle, the REIT vehicle, that we had the biggest concern about, not real estate as a whole. Although real estate could see some challenges if interest rates go up too quickly, because, well, I know firsthand from a client that was looking to do some financing that mortgage rates are probably in that 4.25%, 4.5% range right now, which is still low historically, but a fair amount above where they were even 6-12 months ago.
Mm-hmm.
So fixed income.
So we've seen the Fed raise rates. We did see an increase in March. The expectation is they'll raise an additional 2 times this year. There are some who think maybe 3, but one thing they did do is they kind of raised their outlook for 19 and 20 in terms of those increases. We'll likely see bond yields continue to rise modestly, so we've kind of hit that 3% level on the 10-year Treasury, but we don't necessarily believe that they're going to spike kind of like they did in the taper tantrum from 3 or 4 years ago. But we do think that volatility within the Treasury markets will likely continue as we focus on inflation on one hand and growth on the other. And so we've seen periods in the last 2 years where the 10-year Treasury has moved almost a full percent.
Mm-hmm.
And so that was interesting then from the equity side, then that in the first quarter we started to see the same volatility that we had seen in the bond market last year.
Right.
So from a positioning standpoint, we still believe that bonds provide protection when stock volatility increases. So we showed you kind of where bonds on a total return basis were down in the first quarter. Now, when we looked at that stock volatility, it appeared that it was about the same. But the only thing is that's kind of deceiving from the time period we were mentioning, because actually stocks were up a ton in January.
Right.
And so then we're actually off more than what we showed for the first quarter just due to that timing. So we maintained the diversified mix of bonds that we utilize, and mentioned that staying with higher quality bonds I think will be important because the spread between risky and safe bonds has narrowed, so you're really not getting paid to take on that risk. And then the other thing we mentioned is that municipals still offer an attractive tax equivalent yield.
And that's true if you're in one of the top tax brackets. Obviously, if you're not in one of the top tax brackets, probably the top 2, maybe municipals aren't quite as attractive, but certainly in the top 2 brackets, that's true. So we've talked about the outlook, both from an economic perspective and from a market perspective, which, by the way, I just saw today that I think next week is going to be the anniversary of this recovery, meeting the second longest recovery, or matching the second longest recovery on record. So assuming nothing blows up between now and, I can't remember if it was Monday or Tuesday of next week, the official date that we match the second longest recovery, which is pretty amazing to think, especially for those of you that maybe recall the 2008 crisis and the Great Recession. People, thought, oh my gosh, this thing's going to be down for years and years and years. And now, shortly thereafter, it started improving, and we've gone 10 years with pretty much a bull market, a few occurrences of pullbacks, but pretty much a bull market since that Great Recession. It's quite a story.
Absolutely.
Quite an experience. Hopefully we get another 10 years like the last. In any case, let's talk about bonds, because I think this is one area when clients opened their first quarter reports and they saw some negative numbers on their bond returns, they may be questioned. Well, hey, if you're telling me interest rates are going to keep going up, are my bonds going to keep going down? And should I even keep my bonds if that's the case? But to kind of your point that you just made, bonds can go down, but usually not nearly as much, at least the type of bonds we buy, as stocks potentially could go down. So, bad year in the bond market's down what? 3, 4, 1%, 2, 3, 4, 5%. Right. Bad year in the stock market, 20, 30%. Yeah. Great Recession, 40%. So bonds still play a role in the portfolio. But how are they impacted by interest rates? Well, here, this teeter-totter is probably the best illustration of how interest rates impact bond prices. So as rates go up, bond prices go down. And actually, the longer your bond duration, so the further out on the teeter-totter you are in your duration, the bigger the impact that bond will have. So a duration of, let's say, 1 year might go down a little bit in value, but a bond that has a duration of 5 years theoretically would go down more in value with rising interest rates. And a bond with a duration of 10 years would go down even more. So we haven't really illustrated duration in detail on here, but that's an important component that you should be aware of in your bond portfolio, the duration, because that's going to directly impact the magnitude of either the bond going down because of rising interest rates or the bond going up because of lowering interest rates. And of course, here we put some numbers to the increase. So if you go from 3% to 4%, your bond may go from a value of 1,000 to 925. Again, the actual decline is going to be highly dependent upon the duration, but this, for illustrative purposes, will show the direction. So in this case, if yields went from 3 down to 2, then your bond is going to be going up in value. I don't think we're indicating our expectation that yields are going to be going down any. This is just for illustrative purposes that's how the relationship works. But that doesn't necessarily mean that through the whole cycle of interest rates increasing, that your total return from bonds is going to be negative. And here, Jonathan, you've put together some information talking about interest rates that you're actually receiving from the bond, so the coupon, and then the reinvestment of that coupon, so the interest on interest.
Right. So in the previous illustrations, we showed the relationship between interest rates and the price of bonds. So yes, when interest rates go up, your bond value goes down, but that would be only if you sold it.
Right.
The reality is if you're a long-term investor in a bond, and in this case we're showing a 10-year maturity, you're going to hold it until it matures. So you would get that principal back. So you're really not seeing that loss. So here the two arrows show that interest on interest, so your reinvestment rate. So you're actually better when rates go up. So in the middle column, we're showing you interest rates on a 5-year bond, at a 5% rate on a bond. You're collecting the $500, but then those coupon payments that you receive are then reinvested. You'd make $160 on that reinvestment during that 10-year period. If rates go to 7%, that reinvestment actually increases to $239, okay?
And that's because you've been paid 5% on your bond, but that interest you're going to go back and invest it at 7%. So therefore, your interest on interest increases.
Correct. And the other side of that, though, is yes, well, when interest rates go down, the bond value goes up if you were to sell it. The problem is your reinvestment interest rate is at 3%, so you're making less.
Right.
So that's what we're really showing on that left side. And so then when you look at that effective return, when interest rates go down, your effective return is actually lower. And when rates go up, your effective return is actually higher. And so then the next question somebody might ask is, well, I own a bond fund. Well, that's true, but the actual bonds within the bond fund, many of those they do hold to maturity. And so they manage that process. And they also get that benefit of reinvestment of their short-term bonds. Yep. So that's why the reality is, while in the short run, you might see on a performance report that price change is negative when rates go up, what you're not seeing is the coupon payments that are coming in and that higher interest on interest or the reinvestment that you're going to be receiving.
Very, very good point. Well, let's talk about what has happened with interest rates. Because rates had been very, very low, or at least the short end, very, very low. So everybody knows after the Great Recession, the Federal Reserve started lowering and lowering interest rates. That's what they do if they want to spark growth in the economy. So the blue line here is representing December 31 of 2013, kind of a low point, where on the left side, these are short maturity bonds. On the right side are the long-term maturity bonds. So of course the Fed is only controlling the overnight, the Fed funds rate, the very, very, very far left. And in December of 13, you'll see that very far left side basically at zero. But as you follow that blue line to the right side of this chart, you'll see that the interest rates go up. So of course, you would expect that if you have a 30-year bond, you're going to get paid more interest than if you have a 1-month bond, because you're taking more risk with the 30-year bond. You got to wait a whole 30 years to get it. What's interesting here, Jonathan, is that blue line is a relatively steep line. Short rates very, very low. Long rates quite a bit higher on a relative basis. But the red line, I think that's red anyway.
It's red, yeah.
Okay. Is much flatter. So the short interest rates have gone up, but rather than the long rates going up at the same time, they've actually come down. And it's flattened us. Why do we care about this, though?
Well, one of the things that you tend to see late in cycles, right ahead of recessions, is this yield curve becomes more flat, and then at some point it actually inverts so that the short-term rates are higher than the long-term rates. And so we're not seeing that yet, but that's something that we would want to see. So essentially, the Federal Reserve is trying to slow down growth or slow down inflation, so they continue to increase on the short side. But at some point, bond investors begin to worry about growth, and so then on the long end of the curve, they start to worry about a recession, and then those rates go down, and that's how it flattens and at some point becomes inverted.
Right. And you said, you know, the Federal Reserve is looking to slow down growth or inflation. It's really inflation that they're concerned about, because they have two mandates, right? Maximum employment and price stability. And price stability is counter to inflation. That, you know, inflation's not price stability. So here they're raising the rates in order to hopefully combat inflation, but they've not been very good at that in the past. That is, raising rates but not overstepping their bound and then causing a recession.
Right. And so that's why we watch the yield curves.
Yes. All right.
So we've talked about interest rates this year, and actually back in February, one of the reasons why we did see a pickup in volatility was that increase in interest rates, especially people who were watching that 10-year Treasury. So if you look on the far right, you can see the most recent spike in the volatility index. And during that period, the S&P was down a little more than 10%. If you look back, you'll see kind of that 2015 period when we saw a global slowdown. The S&P was down 12.4%. So we show kind of this back historically. But the other thing to really focus on was how low volatility was in 2017 and 18. And so that was quite a shock in February when we saw the VIX, for example, go from about 8 to about 37 within a week. Now, it's come back down, but we're likely going to continue to see volatility and certainly at higher levels than we experienced last year.
And that really gets us to the slide that I had suggested we would talk about, and that is the intra-year decline slide, where if we look here, the blue bar represents the S&P 500 returns for each year going back. So it's the full calendar year performance. The dots represent, represent the intra-year decline. So if you look at any one of these, I don't know, let's pick a good one here. Go back to like 2003, 2002, where you see that the blue line is up almost to the 30% performance, but the dot is negative 14. So during that year, the S&P at some point, whether it be in January or July or December, at some point was down as much as 14%. And I suspect, well, I don't suspect, I can pretty much say with confidence that a lot of people were concerned that it wouldn't come back. And yet, for the year, it was up almost 30%. So we see this quite often. As a matter of fact, it's pretty astonishing how often we see intra-year declines of 5% or 10% or more than 10%. Yet, that intra-year decline pretty much gets lost in the mix because by the end of the year, the market's up and everybody's happy.
Yeah, another way to really think about that too then is that a 10% decline in a given year isn't that unusual. Right. In fact, it's probably more normal. It's just that volatility was so low last year that people really became complacent. And it's been a while since we've had a 10% pullback.
Yes. And we could have another one. But getting back to our composite, getting back to our outlook, we still are relatively optimistic. We are coming to the late part of the cycle. I think it's kind of hard to argue that we're not, but we just don't see the flashing lights that would say that a major pullback of a prolonged magnitude is in the cards. It could happen, but we just don't see the signs of it quite yet. Is that fair to say?
I think that's fair.
So our other updates and reminders, just to close out today's webinar. Well, first of all, as all of our clients know, probably a month ago now, we did a replacement of an international small cap investment that we had. The position actually had been performing quite well. It was up 22% or so for the last year, but it had some management changes that we weren't comfortable with, and therefore we transitioned into a new position. We continue to work on our share class conversion project, which is kind of an ongoing project where we're continually looking for lower investment costs for our clients. I know Jonathan, you've been busy with John and some other folks on our team in this global optimization project. And then we're also reviewing our passive investments. So for clients that don't know, passive is basically reviewing our exchange traded funds and our index mutual funds, which we can get into in a future discussion. The reminders.
So remember to take your RMD for the year. That's the required minimum distribution if you're over the age of 70 and a half.
And have an IRA.
And have an IRA. Good point. But with the tax law changes, you really should consider gifting RMD to a charity if you're already giving charitable money.
And that could be, I say IRA, I guess. RMDs are required out of 401ks and 403bs and other types of qualified accounts.
First half Minnesota real estate taxes are due in May. Now, assuming you didn't prepay at the end of December last year. Tax season is over. Now that really affected Shannon more than me, so he's way happier.
We have other people on the team that are even happier.
Yes, yes. So looking forward, remember to keep good records for the year. Complete a 2018 tax projection. With the tax law changes, the effect on people will be different. So you'll want to see what that effect on your taxes will be. If you're making quarterly estimates, make sure you pay them on time. Consider utilizing an HSA account. Look at your 401k contributions. Max them if you can. And then if you've turned 50, remember that you can make the catch-up contribution. And then with the tax law change, consider bunching your charitable contributions. And those would be for those that would fall under the standard deduction.
Sure. Yeah. Well,
so that you wouldn't be in the standard deduction.
Exactly. So, and we talked a lot about that in our last webinar. As a matter of fact, that's posted to our website, and you can go back and I think the last maybe 10 or 15 minutes we talked about some of the changes in the tax law. Kathy Nelson, one of our partners, went through a pretty detailed and very impressive review of the new tax legislation. So I'd encourage people, if they didn't have a chance to attend that session, that they look at the website and maybe at least look at that last third of the webinar where Kathy went through the tax law changes. And then a couple other reminders, of course, getting your credit reports. We're continually reminding clients to do that, freezing their credit. And I think the last thing, now that we're through tax season, maybe it's less of an issue, but remember the IRS never contacts you by phone. And we probably saw this maybe more so during the last few months because of it being tax season. And I think probably these scammers are a little bit more active in the first few months as people are compiling their tax information. But we had a number of clients call us saying, hey, I got a phone call from the IRS asking for this or wanting me to call them back. And the answer is always, don't call that number back, because you will never be contacted by the IRS via phone. They communicate via mail. Okay. This is just a reminder that if you have any questions, you certainly can reach out to your SilverOak advisor. But it's also a reminder that we encourage you before the webinar to give us ideas on what you would like us to talk about or questions that you would like us to specifically address. And earlier this week, we actually received 2 really good questions from a individual that was going to participate in today's webinar. We didn't actually address those questions, but I want to mention why. These were such good questions. We want to incorporate them into more detail in our next webinar and spend a little bit more time trying to address the issues. So one of the questions was about the increasing budget deficit and growing debt. and whether there would be a crisis and how that potentially could affect our investment decisions. So our plan is for the next webinar to have some information to go over to address that, because that's a big question. It's a question that probably warrants more than just a few minutes of discussion. And the second question was, who decides where to invest our clients' money? So we're going to put together some materials that will walk through the process of how we make a decision in investing our clients' money, and how they're involved in the process, how we pick the various investments and go through the risk kind of evaluation and the return evaluation and qualitative versus quantitative, kind of that whole mix, and really touching also on our investment committee process. So we really appreciate those questions coming in. We will definitely address them in detail during our next webinar. If you have any questions, again, reach out to your SilverOak advisor. If you're not working with an advisor, you can call me directly. My number is 952-896-5701. Again, 952-896-5701. And if you have a topic for our next webinar that you want to share with us now, feel free to reach out and let us know about that as well, and we'll try and incorporate it into the discussion. Thank you for your time. Thank you, Jonathan, again, and the rest of our team for pulling this together. Have a great day.